Trading charts. They look complicated. Thousands of candles, all moving up and down, creating chaos and confusion. But the truth is, the market speaks a very simple language. If you learn to read just a handful of candles, you can understand exactly what buyers and sellers are thinking. Today, we're going to decode 5 of the most important candlestick patterns that every trader, beginner or advanced, must know. The hammer, the inverted hammer, the bullish engulfing, the bearish engulfing, and the mysterious doji. By the end of this video, you won't just know the definitions. You'll understand the psychology, the confirmation signals, the trend context, and the right way to trade these candles. Let's start decoding the market. Hammer candle, bullish reversal signal. The hammer is one of the strongest bullish reversal indicators, but only if you know where it appears. A hammer looks like this. Small body near the top. Long lower wick, ideally 2 to 3 times the body. Very small or no upper wick. Can be green or red, but green is stronger. Imagine the market forming a hammer and striking the bottom. That's why it's called a hammer. Sellers push the price downward with confidence. But suddenly, buyers jump in. They push the price all the way back up, proving that sellers are losing strength. This tells you, buyers are coming back. Prepare for a reversal, where it works best. At strong support levels, after a clear downtrend. On time frames like 15M, 1H, 4H, daily. Don't enter on the hammer itself. Wait for the next candle to close bullish. That confirmation makes the setup almost 2x stronger. Inverted hammer, early sign of buying pressure. The inverted hammer is like the hammer's cousin. Same purpose, different appearance. It looks like small body at the bottom, long upper wick, very small or no lower wick. This candle tells a very interesting story. Buyers tried to push the price way up. Sellers pulled it back down, but buyers showed enough presence to leave a long upper wick. This indicates buyers are trying to reverse the trend. Momentum might be shifting. Where it works, best at the bottom of a trend. Best on 1H, 4H timeframes. Works well when combined with a support zone. Confirmation. Without confirmation, the pattern is weak. Bullish engulfing, strong reversal power. If there is one candle that screams strength, it's the bullish engulfing. It forms when a small red candle appears in a downtrend, followed by a big green candle. The green candle's body completely engulfs the previous red candle's body. Wicks don't matter, the body is the key. This pattern shows a dramatic shift. Sellers controlled the market, but suddenly buyers entered aggressively, overpowering all selling pressure. It's like buyers said, enough, we're taking over now. What it signals? A strong bullish reversal. Trend may shift from downtrend to uptrend. Very reliable on bigger time frames. Best practices. Look for this at support levels. Use the trend line or moving average for confluence. Avoid trading it in a choppy sideways market. Bearish engulfing. Sellers take control. Now let's talk about the bearish twin. The bearish engulfing pattern. You will see a small green candle in an uptrend, followed by a large red candle. The red candle completely engulfs the green candle's body. This shows the exact opposite story. Buyers were in control, but sellers suddenly stepped in aggressively. They didn't just push prices down. They wiped out all previous buyer movement. This is a huge momentum shift. What it signals? Strong bearish reversal. Trend may change from uptrend to downtrend. High accuracy on 1H, 4H, and daily. Use this pattern near resistance levels. Combine it with RSI overbought zones. Look for a lower high to form after the engulfing candle. Doji Candle, the candle of indecision. The doji is a candle that every beginner misunderstands. But once you get it, you'll read charts more accurately. A doji has almost no real body. Open and close are nearly the same. Wicks on both sides. Looks like a perfect plus or thin line. The doji represents pure indecision. Buyers pushed up, sellers pushed down, and the market closed exactly where it started. Nobody wins. Nobody loses. The market is pausing before a big move. What it signals? A doji is not a buy or sell signal by itself. It is a warning that something big may happen next. Always wait for the next candle. At the top of an uptrend, possible reversal. At the bottom of a downtrend, possible reversal. In the middle of a trend continuation. Let's quickly recap the 5 patterns. Hammer buyers pushing price up from the bottom. Inverted hammer, early sign of bullish reversal. Bullish engulfing, powerful shift from sellers to buyers. Bearish engulfing, sellers taking control from buyers. Doji market indecision, a signal to wait for the next move. These candles aren't magic. They're messages. Simple but powerful signals that reveal what traders are thinking. If this video helped you understand candlestick psychology, make sure you hit the like button, subscribe for more trading lessons, and comment below.